Most people misunderstand their 20s. They think this decade is about freedom, fun, and figuring things out. They think money can wait. They think real responsibility starts later, and that belief quietly shapes everything. Your 20s are not about having everything figured out. They are about building momentum. Momentum is invisible at first. It doesn't feel like progress. It doesn't look impressive. But momentum is what decides whether your 30s feel powerful or stressful, whether your 40s feel free or trapped, whether your life feels intentional or reactive. Money is not the point. Money is the amplifier. It magnifies the direction you're already going. If your habits are chaotic, money amplifies chaos. If your habits are disciplined, money amplifies freedom. And the truth is, most people don't fail financially because they're lazy or stupid. They fail because they delay. They delay learning, they delay saving, they delay investing, they delay responsibility. And delay is expensive. Why your 20 seconds are financially unique. There is a window in life that never reopens. It is the combination of time, flexibility, and recoverability. In your 20s, you can make mistakes and recover. You can live cheaply, you can change direction, you can rebuild. Later in life, mistakes cost more. A bad financial decision at 22 is a lesson. A bad financial decision at 42 can destroy a family. This is why the actions you take now matter so much more than they feel like they should. You don't need to be rich in your 20s, but you do need to be intentional, because intention compounds. The biggest myth about wealth? Most people believe wealth comes from big moments. A lucky investment, a massive raise, a viral business, a breakthrough opportunity. But real wealth is built in boring moments, quiet decisions, daily habits, repetitive actions. It's built when no one is watching. That's why people are shocked when someone becomes wealthy overnight. They didn't see the decade of invisible preparation. This script is not about excitement. It's about effectiveness. The first core principle: start investing as soon as possible. If there is one idea that matters more than any other in this entire discussion, it is this. Time is the most powerful financial asset you will ever have. Not intelligence, not income, not hustle. Time allows money to compound. Compound interest is not linear. It is exponential. At first, it feels underwhelming, almost pointless. But exponential growth doesn't announce itself early. It whispers before it roars. Why people underestimate compounding? Human brains are bad at understanding exponential growth. We think linearly. We assume steady progress looks like steady reward. But compounding works backwards. The biggest gains happen at the end, not the beginning. This is why people quit too early. They look at their early progress and think, this isn't worth it. But what they're really saying is, I don't understand how this works. A simple example that changes everything. Imagine two people. Person A starts investing at 20. Person B starts investing at 25. They invest the same amount every month. They earn the same return. The only difference is time. Person A ends up with hundreds of thousands more, not because they worked harder, not because they were smarter, but because they respected time. Time is the silent multiplier. Why waiting feels safe but is actually risky? People delay investing because it feels responsible. I want to enjoy life first. I'll start when I earn more. I have time. But waiting is not neutral. Waiting has a cost. Every year you delay removes an entire layer of compounding. That lost growth can never be recovered. You can always invest more later, but you can never replace lost time. The procrastination trap. The real danger is not waiting a few months. The danger is becoming the type of person who waits, because that personality spills into everything. Waiting to start, waiting to learn, waiting to act. Eventually, waiting becomes your default. And default behaviors shape destiny, thinking in future dollars. One of the most powerful mindset shifts you can make in your 20s is learning to see money in future terms. Every dollar you spend today is not just a dollar. It is a future dollar that could have grown. When you're young, a single dollar invested can turn into 20 or more over a lifetime. That means every purchase has an opportunity cost far larger than it appears. This doesn't mean you should never enjoy your money. It means you should understand what you're trading away. Awareness changes behavior naturally. The second core principle, never try to time the market. Timing the market is one of the most seductive ideas in investing. It promises control. It promises intelligence. It promises superiority. And it consistently fails. Even professional investors with teams, data, and experience struggle to time markets successfully. Yet, individuals believe they can. This belief costs fortunes. Why timing fails. Markets move based on information, emotion, and unpredictability. By the time you react to news, the market has already priced it in. The biggest market gains often happen when fear is highest, which means the people who try to avoid risk miss the reward. Missing just a handful of strong days destroys long-term returns, and no one knows when those days will happen. The power of doing nothing. The most effective investing strategy for most people is boring. Invest consistently. Hold long-term. Do nothing. This feels too simple to be true, but simplicity is powerful. Doing nothing avoids emotional mistakes. It avoids panic selling. It avoids overconfidence. It avoids exhaustion, and history shows it works. Why emotions ruin returns. Fear and greed are terrible financial advisors. Fear makes people sell at the bottom. Greed makes people buy at the top. Doing nothing removes both. The market rewards patience, not activity. The third core principle, only invest in what you understand. Most financial losses don't come from bad luck. They come from ignorance. People invest without understanding what they own. They chase trends, they follow hype, they listen to confident voices. Confidence is not competence. The danger of FOMO. Fear of missing out is one of the most expensive emotions. It pushes people to invest without thinking. They don't ask how something makes money. They don't understand risk. They don't know time horizons. They only see price movement. Price movement without understanding is gambling. The 4 questions that protect you before investing in anything, you should be able to clearly explain, how does this generate value? How long must I hold it? How volatile will it be? What could go wrong? If you cannot explain it simply, you do not understand it well enough. And that is not an insult. It is a warning. Why missing opportunities is okay. You will miss opportunities. Many of them, that is unavoidable. Trying to catch everything leads to mistakes. Avoiding bad investments matters more than finding great ones. Losses compound negatively. Avoiding them is a skill. The 4th core principle, never invest short-term money. Markets are unpredictable in the short term. They can drop suddenly and violently. If you invest money you need soon, you introduce unnecessary risk. You may be forced to sell at the worst possible time. This is how people lock in losses. Separating time horizons. Money needs jobs. Some money is for emergency, short-term expenses, upcoming goals. Some money is for long-term growth, retirement, wealth building. Mixing these roles creates chaos. Clear separation creates peace. Why stability matters more than max returns. Earning slightly less but sleeping well is a good trade. Peace of mind allows better decisions. Stress leads to mistakes. Wealth is not just numbers. It is emotional stability. The 5th core principle, consistency beats everything. Wealth is not built through intensity. It is built through repetition. Small amounts invested consistently outperform large amounts invested sporadically. This is because consistency removes decision-making. And decision-making invites emotion, making investing automatic. Automation is not laziness, it is intelligence. When investing is automatic, you don't forget. You don't hesitate, you don't overthink. It happens whether you feel motivated or not. That's how habits stick. Why small amounts matter. People dismiss small investments. They think they're meaningless, but small amounts are training. They build identity. You stop being someone who thinks about investing and become someone who invests. Identity is powerful. The sixth core principle, think independently. Independent thinking does not mean ignoring others. It means evaluating information critically, listening without blindly following. The best decisions often feel uncomfortable at first. They go against popular opinion. That discomfort is a signal, not a warning. Long-term thinking in a short-term world. Most people think in days and months. Wealth is built by thinking in years and decades. This creates a massive advantage. When you think long-term, short-term noise becomes irrelevant. How to build wealth in your 20 seconds realistically. Why income alone will never make you rich. One of the biggest lies people believe in their 20 seconds is this. If I just make more money, everything will work itself out. It sounds logical. More income means more freedom. More income means more security. But here's the uncomfortable truth. There are millions of people earning high incomes who are still broke. Doctors, lawyers, executives, athletes. They earn more than most people ever will, yet they live paycheck to paycheck. Why? Because income does not create wealth. Behavior does. If your spending grows at the same pace as your income, nothing changes. If your lifestyle expands every time you get a raise, you stay stuck. This is called lifestyle inflation, and it is one of the most dangerous financial traps you can fall into in your 20 seconds. Lifestyle inflation, the silent wealth killer. Lifestyle inflation is sneaky. It doesn't feel irresponsible. It feels deserved. You get a raise, so you upgrade your apartment, you buy a nicer car, you eat out more, you subscribe to more things. Individually, none of these choices seem like a problem. But combined, they destroy your ability to build wealth. Because every dollar you commit to lifestyle is a dollar that cannot be invested. And invested dollars in your 20 seconds are the most powerful dollars you will ever have. The goal is not to live like a monk. The goal is to control your upgrades instead of letting them control you. The rule of delayed upgrades. Here's a simple rule that works incredibly well. When your income increases, do not upgrade your lifestyle immediately. Wait 6 months during that time. Save the extra money, invest it. Get used to not needing the upgrade. After 6 months, if you still truly value the upgrade, you can afford it without stress. Most of the time, you'll realize you don't need it at all. This one habit alone can be worth hundreds of thousands of dollars over a lifetime. Why your 20 seconds are not for looking rich. Trying to look rich in your 20 seconds is one of the fastest ways to stay poor. Nice cars, designer clothes, luxury apartments. These things signal success to strangers but steal it from your future. Real wealth is quiet. It doesn't need validation. It doesn't need approval. Your 20 seconds are for building the foundation, not the appearance. The people who win long-term are often invisible early on. Habit 7, build your skill set before you build your portfolio. Investing is powerful, but your greatest asset in your 20 seconds is not your money. It's your ability to earn more money. Before obsessing over picking the perfect investment, you should be asking, how can I increase my income? Skills compound just like money. And unlike investments, skills cannot be taken away from you. The fastest way to build wealth early is to focus on skills that are valuable, are rare, are in demand, scale with time. This could be sales, marketing, programming, design, writing, video editing, business operations, negotiation. High income skills give you leverage. They give you flexibility. They give you options. Why saving too much can also be a mistake. This might sound strange, but it's true. Some people become obsessed with saving every penny. They refuse to invest in themselves. They avoid learning opportunities. They avoid calculated risks. They play defense forever. Saving is important, but growth requires offense. If spending money helps you increase income, save time, build skills, create opportunities, then it's not an expense. It's an investment. The key is intentional spending, not emotional spending. Habit 8, use debt strategically or avoid it completely. Debt is a tool, and like any tool, it can help you or destroy you. Bad debt. High interest credit cards, lifestyle loans, car loans for status, impulse financing, good debt used carefully, education that increases income, business investments, real estate with strong cash flow. In your 20 seconds, the safest move is usually minimizing debt as much as possible. Debt limits, freedom. It adds pressure. It forces decisions, and pressure causes mistakes, the true cost of credit cards. Credit cards don't just charge interest. They charge future freedom. When you carry balances, you're borrowing from your future self at an extreme cost. You're saying, I value this purchase more than my future time. Once you see it that way, debt becomes far less attractive. Habit 9, create financial systems, not goals. Most people set financial goals like, I want to save $10,000. I want to invest $50,000. I want to be rich by 30. Goals are motivating, but systems are what actually work. A system answers. How much is invested automatically? How much is saved automatically? Where does income flow? If your system is solid, goals take care of themselves. Automation removes emotion. Emotion ruins finances. Why willpower always fail? Willpower is unreliable. You'll have good days and bad days. Systems work even when motivation disappears. Automatic investing, automatic savings, automatic bill payments. Set it once, let it run, check occasionally. This removes decision fatigue and prevents self-sabotage. Understand risk before you experience it. Risk feels theoretical until it becomes real. Market crashes, job losses, unexpected expenses. If you don't prepare mentally and financially, panic takes over. Preparation means emergency fund, long-term mindset, diversification, clear time horizons. When you expect volatility, it stops being scary. Why panic is the most expensive emotion. Panic causes people to sell at the bottom, quit investing, make emotional decisions, lock in losses. The market punishes impatience and rewards discipline. Your job is not to predict the future. Your job is to survive volatility long enough to benefit from it. Habit 11, stop comparing yourself to others. Comparison is poison. There will always be someone richer, someone faster, someone luckier. Social media magnifies this illusion. You don't see debt. You don't see stress. You don't see the full picture. You only see highlights. The only comparison that matters is, are you better than last year? Why progress feels slow and why that's normal. In the beginning, investing feels pointless. Balances grow slowly. Returns seem small. This is normal. Compound growth is invisible at first, then undeniable later. Most people quit during the invisible phase. The winners stay. At this point, you should understand something critical. Wealth is not about intelligence. It's not about luck. It's not about timing perfectly. It's about behavior, patience, and consistency. Why long-term thinking feels unnatural, but wins every time. Human psychology is wired for immediacy. We evolved to prioritize what happens today, not what happens decades from now. That instinct kept our ancestors alive, but it works against us financially. We overvalue short-term pleasure and undervalue long-term reward. That's why spending feels easier than saving. That's why investing feels abstract. That's why patience feels uncomfortable. But wealth belongs to those who can delay gratification just slightly longer than everyone else. You don't need extreme discipline. You just need more patience than average. Average behavior creates average outcomes. The hidden power of doing boring things repeatedly. There is nothing exciting about saving regularly, investing automatically, avoiding unnecessary debt, living below your means. These actions do not produce adrenaline. They do not generate attention. They do not feel impressive. And that's exactly why most people don't do them. But boring actions, repeated over long periods, quietly create extraordinary results. Wealth is built when discipline outlasts motivation. Why most people quit too early. Early investing feels unrewarding. Your account grows slowly. The numbers seem insignificant. Progress feels invisible. This is the most dangerous phase because this is where most people quit. They think something is wrong. They think it's not working. They think they're wasting time. But what's really happening is that compounding has not reached its acceleration phase yet. The early years are about building the base, not seeing the payoff. The people who succeed are the ones who understand this and stay anyway. The compounding curve no one talks about. Compound growth is deceptive. For a long time, it looks flat. Then it bends slightly. Then suddenly, it rises aggressively. Most of the gains happen near the end. This means the first decade of investing feels slow, but it sets up everything that follows. Your 20s are not about dramatic results. They are about planting seeds. And seeds grow quietly underground before breaking the surface. Why small discipline beats big intentions. Most people have big intentions. They want to be wealthy. They want freedom. They want security. But intentions without systems collapse. Small discipline is what survives. Saving a small amount consistently. Investing automatically. Avoiding unnecessary upgrades. These actions don't require motivation. They require structure. Structure beats willpower every time. The identity shift that changes everything. At some point, investing stops being something you do and becomes something you are. You stop asking whether you should invest. You stop debating timing. You stop reacting emotionally. You simply invest because that's who you are. Identity-based habits are powerful because they sustain themselves. You don't argue with yourself about brushing your teeth. You don't negotiate whether to breathe. That's how investing should feel. Why financial confidence comes from clarity, not balance. People assume confidence comes from having a lot of money. It doesn't. Confidence comes from knowing where your money is going and why. Someone with modest savings but clear systems often feels calmer than someone with high income and chaos. Clarity reduces anxiety. Confusion amplifies stress. Understanding your finances gives you control even before wealth arrives. The role of habits over IQ. Intelligence is overrated in wealth building. Plenty of brilliant people struggle financially. Plenty of average people build massive wealth. The difference is not intelligence, it's consistency. Smart decisions occasionally lose to simple decisions done repeatedly. A simple plan, followed relentlessly, beats a complex plan executed poorly. Why you should expect setbacks. Your financial journey will not be smooth. Markets will crash. Investments will drop. Mistakes will happen. This is not failure. This is normal. The danger is not setbacks. The danger is reacting emotionally to them. Expect volatility so it doesn't surprise you. Preparation turns chaos into inconvenience, separating emotion from decision making. Emotions are signals, not instructions. Fear does not mean danger. Excitement does not mean opportunity. When emotions drive decisions, outcomes suffer. Systems remove emotion. Automation removes temptation. Rules protect you from yourself. Why rules create freedom. Rules sound restrictive, but rules create freedom by removing indecision. When you know how much you invest, when you invest, what you invest in, you don't debate. You don't hesitate. You don't stress. Freedom comes from eliminating unnecessary choices. The myth of perfect timing. People wait for the perfect moment, the perfect time to invest, the perfect market, the perfect setup. Perfect timing does not exist. There is only now. Action beats perfection. Why consistency creates confidence. Confidence is not something you wait for. It's something you build through action. Every time you invest, you reinforce trust in yourself. Every time you follow your system, you prove reliability. Confidence is earned through repetition. The long game mentality. Wealth is a long game played quietly. It rewards patience. It punishes impatience. People who win long-term are not obsessed with short-term results. They focus on staying in the game. Survival comes before growth. Why staying invested matters more than returns. Missing time in the market is far more damaging than imperfect returns. The biggest risk is not volatility. The biggest risk is quitting. Those who stay invested benefit from recovery. Those who exit lock in losses. Time heals volatility. The compound effect of good decisions. Good decisions stack. Saving enables investing. Investing builds confidence. Confidence encourages discipline. Discipline creates momentum. Momentum makes everything easier. Small, positive actions compound just like money. Why your future self is your most important client. Every financial decision is a negotiation between your present self and your future self. Spending prioritizes the present. Investing prioritizes the future. You don't need to sacrifice happiness. You need balance. Treat your future self with respect. They are the one who lives with your decisions. Financial maturity is delayed gratification made routine. Maturity is not about denying pleasure, it's about choosing timing. Enjoy now, but not at the expense of later. Balance creates sustainability. Why most people never feel ready. No one ever feels fully ready to invest. There is always uncertainty. Waiting for certainty guarantees inaction. You don't need certainty. You need a plan. Plans adapt. Inaction stagnates. The final mindset of part 1. Building wealth in your 20s is not about brilliance. It's about respect. Respect for time. Respect for compounding. Respect for discipline. Respect for your future. If you master nothing else, master consistency. That alone puts you ahead of most people. Before you go, remember this. Wealth is not built in dramatic moments. It's built in quiet decisions repeated over time. You don't need to be perfect. You just need to stay consistent. If this video helped you see money, time, and your future a little differently, take a second to support the channel. Please like the video. Subscribe for more long-form content like this. And share this with someone who needs to hear it. Your support helps this channel grow and allows us to keep creating deep, practical videos that actually make a difference. Thanks for watching, and I'll see you in the next one.